It was American businessman Peter Lynch who said, "Never invest in any idea you can't illustrate with a crayon." In this lesson, we are going to compare different types of investments that were covered throughout the previous 9 units on this channel, all to be able to answer the question, you work hard for your money, how can you get your money to work hard for you? Let's make sure we're ready for this lesson by taking a look at warm-up number 2, where we find the slope of the graph of each of the following equations. Y is equal to 3x minus 9 has a slope of 3, being the number in front of x, where y is equal to 9 minus 3x has a slope of negative 3, because negative 3 is what's in front of y is equal to 3 would be a horizontal line, which means it has a slope of 0. And y is equal to 3x has a slope of 3 because that is the number touching x, just as it was in A with 3x minus 9. Now let's take a look at a problem that you will be able to do by the end of this lesson. Rob pays $98 per month with a $100,000 whole life insurance policy. If Rob holds the policy for 29 years and then dies, his beneficiaries will receive $100,000. Compare this to the investment of the $98 per month for 29 years at 4.6% interest compound monthly. For that, we're going to use the formula B is P times 1 plus R over N to the nt power minus 1, all of that in the numerator, all divided by R over N, or 98 times 1 plus 0.046 divided by 12 to the 12 times 29 power minus 1, all over 0.046 divided by 12. A little bit of calculator kung fu, and you will have $71,238.21. There would be many disadvantages to keeping all of your money earned in a box in your home. It would not be safe, it could be lost to theft or to a fire, and it would not grow in value. Throughout your study of financial algebra, you have learned about many different ways your money can be invested so it grows over time and provides you with more income than just the money you earned. Think of the different ways you can invest your money: bank accounts, stocks, bonds, real estate, life insurance, starting your own business, and collectibles. Each of these investments carries an amount of risk and reward. For that reason, many people diversify their investments. They put their money into different types of investments to avoid being subject to potential volatility of one type of investment. Volatility describes the potential severe ups and downs of different types of investments. An investment that is riskier as an endeavor is often called an aggressive investment. Before investing, you need to become knowledgeable about your investment. While a little luck is always helpful, investing is not gambling. The more you learn about potential investments, the more realistic you will be about what you expect. An FDIC-insured bank account is the safest place to keep your money, but other types of investments have a chance to surpass the interest you will earn at the bank. The safest investments are those in which you are assured you won't lose your capital. A safe investment is often referred to as a conservative investment. When you invest, be sure to understand the liquidity of your investment. Liquidity describes how fast your investment can be converted into cash if necessary. If you need money for an emergency and it was in the bank, it would be easy to convert into cash within minutes. If your money was tied up in real estate, it could take months to sell the real estate and get the cash. Let's suppose you invested in collectibles such as antique cars, books, coins, stamps, and so on. Imagine how hard it could be to quickly find buyers for your specific collectibles if you need to convert it to money. A little research coupled with a clear idea of your financial goals will help you determine what investments fit your financial needs best. Also, remember that nothing is a sure thing except an FDIC-insured bank account. Let's take a look at Amelia, who is planning to invest $90,000 of inheritance that she received. She plans on investing 20% into a growth stock, 25% into an income stock, 15% into corporate bonds, and the remainder into a 10-year certificate of deposit, or CD. How much will she be allocating to each category of her investments? We know she's going to be doing 20% into growth stocks, 25% into income stocks, and 15% into corporate bonds. That means she will be investing 60% of the money. From the 100%, that means 40% of the money is left. Amelia invests 40% of her money into CDs. To convert the percentage into decimals and multiply to find the amount into each investment. So of the $90,000 that she's going to get times 20%, or 0.2, she will be investing $18,000 into her growth stocks. 90,000 times 0.25 gives us $22,500 that she will be investing into income stocks, and 90,000 times 0.15 will give us $13,500 she is putting into corporate bonds. 90,000 times 0.4 gives us $36,000 that she is going to be investing into CDs. Amelia diversified her investments by allocating $18,000 to growth stocks, $22,500 to income stocks, $13,500 to corporate bonds, and $36,000 to CD. Notice she invested twice as much into the FDIC-insured CD as she did on growth stock, the riskier investment. Let's check your understanding by finding which of Amelia's investments, besides the CD, carries the least risk. The 15%, or $13,500 that she invested into corporate bonds, carries the least risk of her investments that were remaining. Years ago, Kaitlyn invested a $90,000 bonus she received from her job, as shown in the following graph. Some of the investments were a speculative stock. A speculative stock is a stock in a new, unproven company. They are often inexpensive but very risky, meaning it's more likely than not that you'll lose some of your investment capital. If the corporate bond earns a total of 8%, the growth of the income stock earns 21%, and the CD earns 2%, the speculative stock loses 80% of the value, and the checking account grows 1%. Compute the net monetary gain or loss. Since 10% of the money is invested in corporate bonds and that money grew 8%, the gain is 8% of 10%. So 0.08 times 0.1 gives us 0.008. The corporate bond part of the portfolio gained 0.8%. Since 28% of the money is invested in income and growth stocks and they grew 21%, the gain is 21% of 28%, or 0.21 times 0.28 is 0.0588. The gains on these stocks were 5.88%. Now we need to find 2% of the 40% to the gain from the CDs. So 0.02 times 0.4 is 0.008. The CD accounted for nearly 0.8% gain. We need to find 88% of 9% to get the loss from the speculative stock. So 0.88 times 0.09 gives us 0.0792. The speculative stock accounted for 7.92% loss. You can express this as a negative gain, negative 7.92%. Now we need to find 1% of 13% to get a gain from the checking account, or 0.01 times 0.13 for 0.0013. The checking accounts accounted for 0.13% gain. So with the 0.8% gain, the 5.58% gain, the 0.8% gain, the 7.92% loss, and the 0.13% gain, we get a loss of 0.61%. The net loss for the portfolio was 0.61%, which is less than 1%. To find the money loss, take 0.61% of 90,000. So 90,000 times 0.0061, and we get 549. This 549 loss may not sound like a great deal of money, but investors must always keep in mind that they can lose money on certain investments, and that is why they diversify. Imagine the loss if, instead of diversifying, the investor put all of their money into the speculative stock. Most people lose money in bad economic times. Let's check your understanding by looking at Joe's investment portfolio containing 90% speculative stocks. If all the value of his speculative stocks went down to $0 per share, is it possible for his portfolio to make money? And yes, it is, if the remaining 10% of his portfolio has gains that outweigh the loss of that 90% into speculative stocks. Let's take a look at Claire, who has $12,000 she would like to invest for the next 4 years. She's considering purchasing 240 shares of stock in Castellano Corporation preferred stock. The annual dividend is $1.84 per share. In 4 years, Claire will sell the stock. It could go down in price. If she sells it for $10,500, how much did she gain or lose over the 4 years? First, let's compute the annual dividend from the stock by multiplying 240 times her $1.84, and we get $441. Now to compute the total dividend for the 4 years by multiplying by 4 to get $1,766.40. In 4 years, Claire will sell the stock. It could go down in price if she sells it for $10,500. How much did she gain or lose over the 4 years? Well, $10,500 minus the $12,000 that she paid is a negative $1,500. Add that amount to the amount earned by dividends, so add $1,766.40, and we get $266.40. Usually, people do not talk about investment gains to the nearest cent or dollars. It's unrealistic. They speak in estimates. Claire's investment earned her between $250 and $300. Let's check your understanding by seeing what would Claire's investment earn if the stock sold for $18,700. Well, if she sells it for $18,700 and she purchased it for $12,000, she would make $6,700 on the sale. Add to that the dividend that she received in total of $1,766.46, and she has $8,466.46 in profit, or roughly $8,500. Now, let's compare Claire's investments from the example 3 and the check your understanding to her keeping the money in a CD that paid 3% interest compound continuously for 4 years. We would need to compute the balance after 4 years in the CD by substituting into the continuously compounding formula that we learned back in the unit on banking services. So A is equal to P times E to the NT power, or 12,000 times E to the 0.03 times 4 power. By using the trusty TI 30XS, we can do 12,000 times E to the 0.03 times 4 power and hit enter. We get $13,529.96. So $13,529.96. Subtract from that the $12,000 that she initially invested, meaning she would have made $1,529.96. The original $12,000 earned $1,529.96 in the CD. This is much more than the $266 earned if the stock dropped in price as it did in example 3. It is much less than she would have earned if the stock rose in price, as in the check your understanding problem that followed it. Let's check our understanding of this by saying, what would $12,000 earn if invested for 4 years at 3% compound daily, and round that to the nearest cent? To do this, we're going to have to remember our compound interest formula. So I is equal to P times 1 plus R over N to the NT power. We're looking at $12,000 times 1 plus 0.03 divided by 365 to the 365 times 4 power. Back to the trusty TI-30XS, and we do 12,000 parenthesis 1 plus fraction button 0.03 down arrow 365 right arrow to close the parenthesis, go to the exponent 365 times 4, and we get a total of $13,529.90. But don't forget to subtract the $12,000 that was initially invested, meaning $1,529.90 would be earned with compound interest. Let's take a look at Jennifer and Kevin that bought real estate property for $350,000 for investment purposes. They paid a down payment of $50,000 and borrowed $300,000 from the bank at 5.2% APR. The mortgage is for 15 years. Based on research they have done, they forecast selling the property in 10 years for $1.5 million. Compute the gain when the selling of the property is compared to the total down payment and all of the monthly payments, including interest. Previously, we have learned how to compute monthly payments with the formula M is equal to P times R over 12 times 1 plus R over 12 to the 12 times T power, all over 1 plus R over 12 to the 12T power minus 1. Now we can do this by hand by simply substituting in some values. 300,000 times 0.052 over 12 times 1 plus 0.052 over 12 to the 12 times 15 power, all over 1 plus 0.052 divided by 12 to the 12 times 15 power minus 1. And this feels like a great opportunity to use the spreadsheet we have built in previous lessons. Let's go to the Excel spreadsheet. We put in 300,000 for the value of 3. We put in 5.2 as the interest rate. Compound monthly is 12 and for 15 years. We get $2,403.75. So 180 payments of $2,403.75 is $432,675. The total monthly payments is $432,675. Add that to the down payment of $50,000 and we get $482,675. Subtracting that from the $1.5 million to get the earnings. Now we're going to notice that other expenses are involved in owning real estate, such as taxes, maintenance, insurance, and this is not included in the calculation. But we're going to get $1,017,325. The investment would earn over $1 million. Let's check your understanding by if, instead of buying the property from the last example, the monthly payment amount was deposited every month into an account that paid 4% interest compound monthly for 15 years. What would it grow to and round to the nearest $1,000? To do this, we're going to use the formula B is equal to P times 1 plus R over N to the NT power minus 1 all over Rn, which means we're looking at $2,403.75 times 1 plus 0.04 divided by 12 to the 12 times 15 power minus 1 all over 0.04 divided by 12. And I know we have a spreadsheet to help do this. Let's take a look at the Excel spreadsheet. By simply filling in the values, $2,403.75, 4% interest compound monthly for 15 years, we see that they would have $591,540.01. Now we come to Rob, who pays $98 per month for a $100,000 whole life insurance policy. If Rob holds the policy for 29 years and then dies, his beneficiaries will receive $100,000. Compare this to investing $98 per month for 29 years at 4.6% interest compound monthly. To do this, we're going to use the formula B is P times 1 plus R over N to the NT power minus 1 all over R over N. And why waste time filling this in when we can go straight to the Excel spreadsheet? This means simply filling in the values, $98 at 4.6% interest compound monthly for 29 years, and we get $71,238.21. So after simplifying and rounding to the nearest cent, the future value is found at $71,238.21. You can look up future value calculators online if you didn't want to have to do this yourself. Let's check your understanding by looking at, in the last example, what is the advantage of investing in a life insurance policy? Well, if Rob dies at any time during the policy period, his survivors get $100,000. That is more than the amount that would have been earned in the previous 3 decades.